Every week, a new think tank releases a report saying Gen Z is locked out of the property market. Every month, a politician promises to fix housing affordability for young Australians. Every year, news articles declare the Australian dream is dead for an entire generation. But here's what nobody really discusses. Can Gen Z afford property? Not the emotional answer, not the political answer. The actual, factual, mathematical answer based on real income, real prices, and real financing options. The answer is more complicated than yes or no. Some Gen Z can afford property. Many can't. Most could if they made certain choices, but those choices require trade-offs that many aren't willing to make. And a significant portion genuinely cannot afford property at any realistic price point given their circumstances. By the end of this, you'll understand exactly who can afford property, who can't, what it actually takes to buy, and whether the Australian dream is really dead or just different than it used to be. Let's start with the numbers. What does property actually cost right now? To afford something, you need to understand what it costs. Let's break down the actual total costs of buying property in Australia in 2025. The purchase price. The median Australian house costs $844,000, but this varies dramatically by location. Sydney median house is $1.7 million. Melbourne median house is $1.05 million. Brisbane median house is $1.04 million. Perth median house is $935,000. Adelaide median house is $1.01 million. Hobart median house is $730,000. Canberra median house is $934,000. For apartments or units, prices are lower but still significant. Sydney median unit is $835,000. Melbourne median unit is $555,000. Brisbane median unit is $671,000. Most Gen Z can't afford the median property in their preferred city, so they need to either move to a cheaper city, buy an apartment instead of a house, or buy in an outer suburb. This is the first trade-off. The deposit. To buy with most lenders, you need a 20% deposit to avoid mortgage insurance. That's a $169,000 deposit on the $844,000 median house. $340,000 deposit on a $1.7 million Sydney house, $111,000 deposit on a $555,000 Melbourne unit, $187,000 deposit on a $935,000 Brisbane house. Some lenders will lend at 10% or even 5% deposits with mortgage insurance. Mortgage insurance typically costs 2% to 5% of the loan amount, so another $15,000 to $35,000 on top of the price. First home buyer schemes in some states provide grants, typically $5,000 to $20,000, or reduced stamp duty, which helps a bit but doesn't solve the fundamental problem. Stamp duty. Stamp duty is charged on purchase and varies by state. NSW, roughly 5% of property value. Victoria, roughly 5% of property value. Queensland, roughly 3.5% to 4% of property value. WA, roughly 4% of property value. SA, roughly 4.5% to 5% of property value. On an $844,000 property in NSW, stamp duty would be about $42,000. In Queensland, it might be $29,500. This is pure cost that must be paid at settlement before you even own the property. Some first home buyers get stamp duty exemptions or reductions, which helps, but you still need the money up front. Interest and repayments. On an $844,000 property with a 20% deposit,
$168,800, an 80% loan, $675,200, at current interest rates of 3.6%, your monthly repayment on a 30-year loan would be approximately $3,050 per month, or about $36,600 per year. This assumes interest rates stay at 3.6%. If rates rise to 4.5%, repayments rise to about $3,400 per month. If rates rise to 5.5%, repayments rise to about $3,800 per month. To afford $3,050 per month in repayments, lenders typically require your household income to be at least $127,000 annually, assuming 30% of gross income goes to housing. That's about $9,770 monthly gross income, or about $7,500 monthly after tax. For a Sydney median house at $1.7 million with 20% deposit, borrowing $1.36 million at 3.6%, monthly repayments would be $6,100, requiring household income of about $244,000. Very few Gen Z have income anywhere near that. Other costs. When you buy property, you have additional costs. Legal fees, $800 to $1,500. Building inspection, $400 to $800. Council rates, $1,200 to $2,000 annually, depending on location. Water, $500 to $1,000 annually. Insurance, $800 to $1,500 annually. Maintenance, $2,000 to $5,000 annually on older houses. Body corporate or strata fees for apartments, $1,500 to $5,000 annually. So, total annual holding costs beyond the mortgage are $5,000 to $15,000, depending on property type and location. This needs to be affordable on top of mortgage repayments. What does Gen Z actually earn? Now let's look at Gen Z incomes. Generation Z is generally defined as people born between 1997 and 2012, so they're currently aged 13 to 28. The older Gen Z, early mid-20s, are entering the workforce now. The younger Gen Z are still in school or just starting careers. For our purposes, let's focus on Gen Z aged 22 to 28 who are working full-time. Income distribution. The median full-time income in Australia is about $65,000 per year. For young workers aged 22 to 28, median income is lower, typically around $55,000 to $60,000. This varies significantly by qualification and field. High school graduates, typically $45,000 to $55,000. Certificate or diploma holders, typically $50,000 to $65,000. University graduates, typically $60,000 to $75,000 in early career. Specialized degrees in engineering, medicine, law, or finance, typically $70,000 to $100,000 plus. Some Gen Z earn excellent incomes. Graduate engineers might earn $80,000 to $100,000 straight out of uni. Accountants might earn $75,000 to $90,000. Lawyers might earn $70,000 to $150,000 plus, depending on specialty. But many Gen Z earn modest incomes. Hospitality workers might earn $50,000. Retail workers might earn $48,000. Trade apprentices might start at $35,000 to $45,000 before progressing to $80,000 plus as they complete their apprenticeship. The key point, median Gen Z income is about $55,000 to $65,000. This is the typical earnings level, not the maximum. Many Gen Z earn less, some earn more. Household income. Some Gen Z buy property with a partner, combining two incomes. Household income for a couple where both work full-time and earn median income would be about $110,000 to $130,000 combined. This is better, but still limited. With $120,000 household income, you can borrow about $480,000, assuming 30% of gross income goes to housing. This is enough to buy with a 20% deposit in Perth, Adelaide, or outer suburbs of Brisbane or Melbourne. But it's nowhere near enough for a Sydney property or inner-city Melbourne. Some Gen Z have parental support. Parents with substantial wealth might gift deposits or guarantee loans, enabling their children to borrow more. This is a huge advantage that many Gen Z don't have. The math. Who can actually afford what? Let's do the actual math for different scenarios. Scenario 1. Single Gen Z earning $60,000. Income is $60,000 annually, approximately $4,600 monthly after tax. Maximum borrowing, lenders typically lend 5 times income, so $300,000 maximum. With a 20% deposit, $75,000, you could buy a $375,000 property. With a 10% deposit, $75,350 plus mortgage insurance of $10,000, you could buy a $387,500 property. In 2025, $375,000 buys you an apartment in outer suburbs of Sydney or Melbourne, an older house in regional Queensland or South Australia, a house in smaller regional cities like Albury, Bathurst, or Toowoomba. It doesn't buy you much in major capital cities. This person has options, but limited ones. Scenario 2. Single Gen Z earning $75,000. Income is $75,000 annually, approximately $5,760 monthly after tax. Maximum borrowing, $375,000. With 20% deposit, can buy $468,750. With 10% deposit, can buy about $480,000. In 2025, $480,000 buys you an older house in inner Perth or Adelaide, a newer house in outer Brisbane or Adelaide, a house in many regional areas. This is more options. This person could realistically buy something reasonable, though not a premium property in a premium location. Scenario 3. Couple, each earning $65,000, combined $130,000. Combined income $130,000 annually, approximately $10,000 monthly after tax. Maximum borrowing, lenders will typically lend 4.5 to 5 times combined income, so $585,000 to $650,000. With 20% deposit, $146,000 to $163,000 can buy $731,000 to $812,000. With 10% deposit, can buy about $815,000 to $895,000. In 2025, $800,000 buys you a median-priced house in Perth or Adelaide, an outer suburb house in Brisbane or Melbourne, a decent apartment in inner suburbs of Brisbane or Melbourne. This couple has real options. They could buy a reasonable property in a good location if they're not set on Sydney or inner Melbourne. Scenario 4. Couple, one earning $80,000, one earning $60,000. Combined $140,000. Combined income $140,000 annually, approximately $10,800 monthly after tax. Maximum borrowing $630,000 to $700,000. With 20% deposit, $787,500 to $875,000. With 10% deposit, can buy about $875,000 to $960,000. In 2025, $900,000 buys you a decent house in Perth or Adelaide, an outer middle suburbs house in Brisbane or Melbourne, a nice apartment in many locations. This couple is in a reasonable position to buy. They have choices. Scenario 5. Couple, both high earners, $100,000 plus each, equals $200,000 plus. Combined income, $200,000, approximately $15,400 monthly after tax. Maximum borrowing $900,000 to $1 million. With 20% deposit, can buy $1.125 million to $1.25 million. With 10% deposit, can buy about $1.25 million to $1.4 million. In 2025, $1.2 to $1.4 million buys you a good house in inner Melbourne, a house in suburbs closer to Sydney, a nice apartment in Sydney, an excellent house in Perth, Adelaide, or Brisbane. This couple is in a very strong position. They can buy in most locations in Australia. The reality, what this means. The data tells us single Gen Z on a modest income, $50,000 to $65,000, can buy property, but options are limited. Probably need to buy regionally, in outer suburbs, or buy an apartment rather than a house. Can afford something, but not their first choice. Single Gen Z on a good income, $75,000 to $90,000, can buy reasonable property in most cities, can buy outer suburbs in major cities, could potentially buy a house with partner support or gifts. This is achievable, but requires choices about location and property type. Couple with combined moderate income, $110,000 to $140,000, can buy reasonably priced property in most locations outside Sydney inner suburbs, can access outer suburbs in major cities, and decent property in smaller cities. This is realistic and achievable. Couple with combined strong income, $160,000 plus, can buy well in most locations, including inner suburbs of Melbourne and Brisbane, outer suburbs of Sydney, can afford good property almost anywhere. This is quite achievable. Single or couple trying to buy median-priced property in Sydney, $1.7 million house or $835,000 unit, need household income of $244,000 plus for a house or $150,000 plus for a unit. This is achievable for some Gen Z in specialized fields, but not typical. The fundamental truth is, yes, Gen Z can afford property, but not everywhere, not immediately, and not always what they want. The deposit problem, the real barrier. The actual barrier isn't monthly repayments for most Gen Z. It's saving the deposit. To save a $100,000 deposit, assuming you can save $15,000 per year, which is aggressive if you're paying rent of $600 per week, takes 6.7 years. To save a $150,000 deposit takes 10 years. During those 10 years, property prices are rising. By the time you've saved your deposit, prices have often risen enough that you need a bigger deposit. This is the real trap that locks Gen Z out. It's not that monthly repayments are unaffordable. It's that saving the deposit while paying rent is nearly impossible. But there are solutions. Solution 1. Accept lower deposit standards. Some lenders offer 5 or even 3% deposit options. You pay mortgage insurance, but you get into the market sooner. A $20,000 deposit might cost $10,000 in insurance, so $30,000 total. But you're buying a property 5 years earlier and capturing 5 years of price growth. This often makes financial sense, even with the mortgage insurance cost. Solution 2. Parental support. This is the uncomfortable reality. Gen Z with wealthy parents have massive advantages. Parents gifting or guaranteeing $50,000 to $100,000 of deposit makes buying feasible. Gen Z without parental wealth are significantly disadvantaged. This is why intergenerational wealth transfer is becoming the defining factor in who can afford property and who can't. Solution 3. Dual income. A single person earning $60,000 might struggle to save $100,000, but two people earning $60,000 combined can save it more feasibly, especially if they're living together. Buying with a partner dramatically improves affordability. Solution 4. Shared ownership. Gen Z are increasingly buying with friends or family members who aren't romantic partners. Shared house ownership with friends can work, though it requires legal documentation to be clear about ownership stakes.
Solution 5. Buy regional first. Buying an older house in a regional area for $350,000 to $450,000 is much more feasible than buying in a capital city. Gen Z could buy regionally, build equity, then sell and upgrade to a capital city property in 5 to 10 years. Solution 6. Buy a unit first. Units are 30 to 40% cheaper than houses in most markets. Buying a one-bedroom apartment for $450,000 to $550,000 is more feasible than buying a house. Build equity in the unit, then sell and buy a house when income has increased. The psychological issue: expectations versus reality. Here's something nobody talks about. Many Gen Z can afford property, but they can't afford the property they want at the price they want in the location they want. A Gen Z couple earning $130,000 combined can't afford an $800,000 property, but they want a $1.2 million house in inner Melbourne or a $1.5 million house in Sydney's inner west. They can't afford that, so they conclude they can't afford property. This is the expectation problem. Gen Z, understandably, want what older generations have. They see boomers who own $2 million houses and think that should be achievable for them. But it's not, because those boomers bought those houses for $200,000 to $400,000 30 years ago, not for $2 million today. The trade-off for Gen Z is buy a cheaper property in a less desirable location, or buy a smaller property, apartment instead of house, or wait 5 to 10 years for income to increase, or take on higher debt levels, borrowing at 90% LVR with mortgage insurance. These are real trade-offs, but not fake hardships. They're trade-offs, not impossibilities. The wage growth problem. Here's where it gets harder. Gen Z income is growing, but slowly. Wage growth in Australia has been running 3 to 4% annually. Property prices have been growing at 5 to 7% annually. This means property is becoming less affordable over time, not more. A Gen Z person earning $60,000 today will earn about $78,000 in 10 years, assuming 3% annual wage growth. But property prices will probably increase from $844,000 to about $1.18 million at 5% annual growth. The affordability ratio got worse, not better. This is the long-term problem. Unless property price growth slows to match wage growth, property becomes progressively less affordable regardless of how hard Gen Z works. This is structural, not individual. It's not about Gen Z being lazy or unprepared. It's about the economics of supply and demand in a constrained housing market. The regional opportunity. Here's what often gets overlooked. Regional Australia is much more affordable. A Gen Z couple earning $130,000 could buy a nice house in Geelong, Ballarat, or Bendigo for $600,000 to $750,000, a great house in Newcastle or Wollongong for $700,000 to $850,000, an excellent house in Toowoomba, Hobart, or Launceston for $500,000 to $650,000, a fantastic house in regional areas like Orange, Dubbo, or Coffs Harbour for $400,000 to $550,000. With improved technology enabling remote work, regional buying makes increasing sense. You get better value, lower property costs, more space, and often better quality of life. You sacrifice proximity to major employment centers and some entertainment and cultural options. But for Gen Z who can work remotely, regional property is actually quite affordable. The ultimate answer: can Gen Z afford property? Let me be completely honest and clear. For Gen Z with household income below $80,000, owning property in major capital cities is very difficult. Options exist in regional areas or buying lower-priced units in outer suburbs. It's possible, but requires sacrifice and trade-offs. For Gen Z with household income $100,000 to $150,000, owning property is realistically achievable.
You can buy in outer suburbs of major cities, inner suburbs of smaller cities, or good property in regional areas. This is the normal path, not an exceptional achievement. For Gen Z with household income $150,000 plus, owning property is easy. You can buy good property in most locations. You might not be able to afford a $2 million house in Sydney's inner west, but you can afford a $1 million property comfortably in most Australian locations. For Gen Z with parental wealth supporting deposits, the picture improves dramatically. With a $100,000 gift or guaranteed deposit, property is achievable at significantly lower income levels. For Gen Z without parental support, single, earning below $70,000, property ownership is extremely difficult and may not be realistic in the short term, next 5 years. But it becomes increasingly achievable over 10 to 15 years as income grows and savings accumulate. The Australian dream of owning property isn't dead for Gen Z, but it's different than it was for previous generations. You might not buy your first property until 35-40, not 25-30. You might buy an apartment first, not a house. You might buy regionally, not in your preferred major city. You probably need dual income, not single income. You probably need some parental support or will have higher debt levels. You might buy a smaller, older property than you ideally want. But owning property is still achievable for most Gen Z who have stable employment and reasonable incomes. It's harder than it was. It requires more trade-offs. It takes longer, but it's not impossible. What would actually help? If we want to genuinely improve Gen Z housing affordability, we need more housing supply. Building more homes would reduce prices and improve affordability. This is the most important single factor. Faster wage growth matching or exceeding property price growth, would improve affordability ratios. This requires economic growth and competitive labor markets. Reduced transaction costs, lowering stamp duty and legal fees, would reduce the upfront cost of buying and help deposits go further. Better rental policy, making renting more stable and affordable, would reduce pressure on Gen Z to buy immediately. Some Gen Z might prefer to rent longer if rental markets were less stressful. Better planning, allowing more flexible development in established suburbs, would increase supply where demand is strongest. Tax reform, removing negative gearing or capital gains tax concessions, would reduce investor demand and potentially reduce pressure on prices, though this is controversial. But these solutions face political obstacles. Most governments lack the political will to implement them because voters with property benefit from high prices. The bottom line: can Gen Z afford Australian property? For most, yes, with trade-offs and time. For some, yes, easily. For a minority, no, not realistically in the medium term. The property market hasn't been completely closed to Gen Z. It's just changed from relatively accessible to most workers to accessible to those willing to compromise on location, property type, or timing. That's not nothing. That's a significant shift that creates real hardship for some Gen Z, but it's not an absolute barrier. The question Gen Z need to ask isn't, can I afford the property I want? It's, can I afford a property that will serve me well? The answer to that second question is usually yes, if you're willing to accept different options than previous generations had.